Hey, y'all, welcome to another episode of Tech Backstage, coming to you live on a Tuesday, second show of the week, joined today by John Green, CEO and co-founder at Nada. John, how you doing?
Hey Eddie, I'm doing very well. Thanks for having me.
Yeah, thanks for being on the show. I'm excited to talk about this. I think what you guys are doing at Nada right now touches a lot of important things, especially with the way the economy's going, and I think it's top of mind for a lot of people, and
Mhm.
especially with new generations coming into the home ownership arena and trying to navigate that. I think it's definitely a lot more complex than the system that our parents were dealing with. So I'm excited to talk about it. Before we jump into this, love to hear a little bit about you. Let the viewers know kind of your backstory and how you ended up becoming CEO and co-founder at Nada.
Yeah, happy to share. My story is a bit different. It kind of tells in two pieces. One, I'm from a very small town in North Louisiana, pretty much void of too much opportunity. But my way out of there, in my late teens, early 20s, I formed a punk rock band with a few buddies, and we ended up being signed at the time by a sizable record label, and I got to travel and do that for a career as a touring and recording artist, punk rocker,
Cool.
for almost 4 years. And then so that's part one, a bit of the nonconformist who I am, and then I got into the mortgage industry, starting in sales, working through various capacities of risk control, quality assurance, into strategy and innovation. I spent over a decade in the mortgage financial services sector, and kind of combined those two, a bit of the strategist professional with the never left me nonconformist, gave me some comfort and a bit of character and grit and grind that I think it took to bring together a group of people to build something like Nada, to create something different, something that's very community centric, and authentic. So that's me in a nutshell. The constant duality of the punk rocker with the mortgage banker guy.
I love that. I actually just had yesterday we had a lady by the name of Shannon Bex on the show as well, and she grew up in the music industry. I started in the music industry as well,
Okay,
though
cool.
as an audio engineer, because I'm just not a very good songwriter, man. And so it was either be an audio engineer or be a bass player, and audio engineer paid better than bass player. Um,
Yeah, funny.
but the thing I love about that, that background is that, just like I was talking to Shannon Bex about yesterday, is that there's a lot of things that you'll learn in the music industry that actually translate to, soft and hard skills in a career. A lot of people don't always
Yeah,
identify that, but I would like to challenge anybody to get in a van and go tour around the U.S. for 2 years, and
yeah,
you'll probably come out with some life skills that you didn't know you actually needed or had the ability to have. But I think it translates well to being an entrepreneur and a CEO, because a lot of it's problem solving. And anyways, I think that's a neat backstory, and I think it definitely lends well to to the position you're in today. Um,
yeah.
Before we
Completely
dive
agree.
in too much to the topic, want to just kind of get your, as somebody who's been in the mortgage industry and in around real estate for a while, love to kind of get your opinion on where we're currently at with the market, and just the kind of the macro of what's happening right now.
Yeah, I don't want to overspeak in terms of, I don't like to play forecasting or outlooks or anything such as that. I always like to observe what's out there. And, I mean, right now we're dealing with inflation, rising interest rates has a certain amount of a depression on asset values. And for me, one of the things that I see most is, I know a lot of folks, great folks that are in the mortgage industry that have been massively impacted because of how sensitive those operations are to the interest rate market, right? Really, the total economic market. So that's something that I'm, constantly paying attention to. At the same time, it's you have a ton of homeowners or non-homeowners that, still value, real estate ownership, and as such, you may own a home, you may not want to move out of it because you're afraid to get into a new loan considering rates, and you want to hold I think we're in a very rate sensitive environment because of the low rates. I think it's a broader audience is more aware and sensitive to interest rates than in other cycles. Um, so it becomes kind of a. I think in some cases it can be a trap. It can be felt as a trap right now. So that's part of what we as a company have designed products that are less sensitive to that. And we can talk about that later. But current state, I think that real estate as an asset class has proven to be one of the most stable asset classes. Of course, there was the economic impact caused by the housing market crash. But outside of that, it's been an asset class that's held really strong in different economic stress points. And so I think that's something that's important to look at, just historical facts, and then we can all presume there's different outlooks on what the future is going to be, but history shows that it's an asset class that's going to hold strong, and that ownership in real estate is something that is appreciated across multiple generations. Your issue becomes accessibility, and that's the number one thing that's being impacted right now with the rising interest rates. Rising interest rates reduces the amount of lenders and operators in a market, which creates less competition to homeowners or prospective homeowners, and they end up paying for that, right? Because there's less people in market, so there's less market advantage to the consumer.
Yeah, and I think there's a couple points there that I think you hit on that I think are really important. Especially with the first thing you said about accessibility, I think that's huge, just because not just with the interest rates, but with the way that real estate appreciated during the pandemic. I don't think anybody actually foresaw that. I think we were actually kind of all expecting it to go the other way. And actually me being, I moved to Austin in 2010. So to watch what happened to the Austin housing market over the last,
it was insane.
Yeah, it's madness, right? I remember a house that me and my buddy moved into back before I was married. It's like 250,000. I think I saw it on Zillow the other day for like $750,000, $800,000, and I mean it's only been 5 or 6 years, so it's been that's massive appreciation. And you're talking about accessibility, not just with interest rates, but there's people in the Austin market that sold their houses because hey, this is a great market to sell in, and then all of a sudden they can't actually get into another place because the housing, the prices are going up so much. And I mean, then the rates were low, and now we're dealing with the interest rates being more of a blocker. But accessibility pricing has been another big concern for a lot of people. And I think you touched on real estate being an asset class that traditionally long term not only holds its value but appreciates. But one of the things that I've always looked at is for example, my parents back when when they were young, or at least their parents back post World War II, you could get into real estate with one minimum wage job in the house, and the wife could stay home. And nowadays that's not necessarily the case, right? And so real estate as an asset class, it's absolutely it's something that I'm a firm believer that you should hold real estate. But especially for people starting out, how do they get into real estate, right? Like how do you get over those, even if you do an FHA 3.5% down, that can still be tens of thousands of dollars in down payment plus closing costs, plus, you know what I mean? And so for somebody who's just starting out, maybe a young married couple in their mid 20s, that's still a lot of money. That's still more than a lot of people have in the bank. And so I think this is a perfect way to kind of segue into what we want to talk about today, which is unlocking real estate wealth, and talking about how do you actually get into an asset class like real estate when it's kind of like this unreachable thing that that you're like, well, I don't even have $10,000 in my bank account, so how am I going to put down payment on a house? And but like you said, as far as long-term financial stability and growing net worth, real estate has proven historically to be one of those asset classes that you should own. So kind of that catch 22 is like, well, yeah, you should have it, but how do you get into it?
How do you
right
get to it?
Yeah. So I'd love to hear a little bit about first and foremost about what you guys are doing at Nada, but also kind of your opinion on how to get started and how to really get into this space, even when maybe you're not a traditional homeowner.
Yeah, yeah, no, happy to share that. Nada as a company, our mission is really around accessibility to real estate as an asset, and we do that. We serve a two-sided marketplace. On one side, we issue and offer real estate investment funds that we term city funds. These are index-like investment funds that hold real estate in specific cities. So we currently have active Austin, Dallas, Miami, Tampa, a few others. You get the idea. In the underlying assets are fractional investments in homeowner equity in like the Austin market. So you touched on something. So someone in Austin, a homeowner in Austin, may love living in Austin, and they've seen a substantial amount of home appreciation. They don't want to move, right? If they were to sell their house now, they'd be moving adjacent in market to a home of similar value and be exposed to a higher interest rate market. So how can they realize this appreciation? This is where we serve the other side, to where we offer direct to homeowner, if you will, finance services. So we have a home equity investment product that we term home shares. And the home share allows the homeowner to sell a fraction of their current home equity in exchange for cash that we issue them today. And the underlying instrument is not a debt instrument, it's an equity investment. So that homeowner they're not burdened by any additional debt. There's no interest rate, no monthly payments, et cetera. So that's how a city fund is able to get diverse exposure representing a certain housing market very quickly with limited capital and also limited resources, since we're not going out and doing a ton of property management, et cetera. So these city funds are pools of equity capital to finance these homeowner equity investments, and on both sides, because we're very much a mission-driven company in how we design products. So we're very thoughtful and cautious in how we designed the SEC qualified investment offering to be very fair and transparent to the retail investors that we're providing access to. And equally, that it's designed to finance a consumer product that is very fair and equitable to a homeowner. And to answer your question around how we're enabling accessibility to ownership of, in particular, home equity in these markets, we've it's a bit technical, and I can nerd out on the technicality here, but a lot of compliance and governance with the appropriate regulators. So in this case, SEC and FINRA. We're SEC qualified and FINRA registered for our investment offerings, and it's a very detailed structured offering that allows us on our platform and on our app to accept investments from retail investors, U.S.-based retail investors. And so our starting point is only $250, unlike many private REITs, real estate investment funds. That's very low entry point. We have very low management fees. We only charge 1.5% fund management per year, so that we make it very affordable and accessible to retail investors to own a piece of their favorite city. So you may be renting, you may be you may own a home. We see a lot of alums from some of the, like Austin in particular is a big college city. So you see a lot of people investing back in the market now, because for $250, you can own a fractional piece of home equity in that market. And by design, the assets are moving up and down according to the movement in that market.
Mm-hmm.
So when you're in a depressed state like now, maybe home appreciation rates are going to stabilize a bit. You can kind of say it's a buy the dip concept, right? Because you can buy in at low and expect it to rebound. Whatever you may see in terms of like your own market research regarding something that's very public, that's home appreciation.
Yeah, no, absolutely. So I got a question around that as well. So, in traditional home ownership models, you're typically looking at, buying, typically you're going to get a mortgage financed, and, you're going to put it on, probably a 15 or 30 year. I think a lot of people
Mm-hmm.
opt for the 30 year, right? So you're really looking at it as a long-term investment, right? How does fractional home ownership, especially through the Nada platform, how does that compare to, to traditional home ownership? Are you kind of looking for the same thing, like that long term, or are they really like you said, coming in? Are they able to come in, buy the dip, watch it appreciate, and then get out quickly? Or how do you guys typically look at fractional home ownership? Is it more of a long term play, or is there kind of intermediaries in between there?
Yeah. So this asset has, I guess call it asset or financial instrument, another way you're looking at it. It's proven to have a 5 to 6 year term in terms of when that option is exercised, and often it's because the homeowner is selling the home. You know, a mortgage servicer will usually look at something like that as a 6 to 7 year churn rate on a home on owner occupied properties. And we're seeing something similar with this asset too. So if you're looking at it in the lens of I'm an investor in a city fund that holds a pool of these home shares, then real estate investment is, I would advise to be looked at as a longer term investment. But unlike most private REITs, we do have a secondary trading platform element there. So we are appraising the underlying assets that we hold using AVM models, automated valuation models, and publishing NAV, net asset value, which is really kind of a baseline for potential trade.
Mm-hmm.
And so we have a primary market issuance now where someone can buy in, and then in different cycles, we'll turn it off and offer it to secondary so that a shareholder can sell their shares to a prospective new buyer into a fund. So that's the liquidity strategy. So it's a bit more flexible. That's, again, in design, accessibility in and out to cash, less of a long-term hold. Just based on how fast they really want to see that movement in their money. And on the homeowner side, it is a 10-year instrument, and it is complementary to a first lien, so like a traditional mortgage. The first lien holder would see it as a advantage, as a way for their customer to get cash out that could be used to pay down debts. The homeowner can use it to offset any kind of impact they may have from inflation. Really anything that could be affecting them, whether it's to use their home equity to pay their kids' school, to buy groceries. We don't restrict the usage. It's just the use cases have been, from that to investing to really, kind of a multitude of things.
Mm-hmm.
But they work alongside. It's a second lien in structure, not too dissimilar to that of like a HELOC or a home equity loan.
Okay, cool. Now, so one of the things that you'd mentioned earlier is, then I want to kind of focus on the homeowner side for a second. You said this is not, this is more like an equity. This is not a debt instrument, right? But
Yeah.
let's say that a homeowner comes in and they're like, oh, I want to get some cash out of the house now. And you're talking about it being a 10-year term, basically. So what happens if, in 10 years, the homeowner decides, oh, you know what, I'm not looking to sell. How do you guys, how does that, particular situation work? Or at that point, are you looking at kind of getting the equity investment back from the homeowner with, potentially a percentage on top of it, or how do those situations play out?
Yeah, it's a great question. So throughout the term, we have servicing that goes along with the origination of the asset. And in our our tech model that we built, because we have the underlying data on the property value, the mortgage pay down, et cetera, we're publishing real time what the payout balance is and all this, so that it's very much visible and transparent to the homeowner. So it's not something that you should ever be a shock, right? Whether it's a call center calling out or just data that we're providing the homeowner. But in the event that a 10-year term does expire, we do have the right to exercise that option. So we would say they sold 10% of their equity, then we bought 10% of the home's future value. Now that could be, we're sharing in appreciation or depreciation. So if it depreciates, we'd share in 10% of the depreciation. So that's what makes it a true equity investment. And that would be done by, we'd order a field appraisal on the property and then define that. But at the same time, if everything's going well with the property and the homeowner doesn't want to sell or get a cash out refinance, which would be sometimes an economic, in a different economic market where rates are more, favorable.
Right. Yeah.
These are the options, but we can actually, for lack of a better term, refinance the equity investment as well, because it serves a city fund investment vehicle, and the investors there, just the same if the asset's still appreciating, so long as we're receiving cash outs from some others. So it's very flexible in that regard. And similarly, no early prepayment penalties or any lockup periods or anything such as that.
Okay, cool. No, I think that's great. I think like you're saying, I think I'm trying to think back to when I was a kid, because I'm pretty sure we moved about every 6 to 8 years. Like, I don't think we ever, I don't think we ever made it to, getting anywhere near the term of the mortgage. So I think that makes a lot of sense. Let's talk a little bit about fractional home ownership and how it, how you see it relating to current generations, building wealth and building net worth, right? Again, I think the stock market obviously is something that it's very similar, but traditionally in the past, it's always been, hey, you're going to buy a house and you're going to live in it, and that's you're just going to dump your money into that as opposed to rent. How do you see fractional real estate ownership? How do you see it contributing directly to the coming generations building wealth over a period of time?
Yeah.
This seems to be a more common theme nowadays, right? Because like whole ownership starting to get less and less accessible. So how do you see it contributing to the underlying wealth of coming generations?
I think, honestly, just to be frank, I think that younger generations view this as a common sense approach. I think the traditional approach of a 30-year mortgage in concept is pretty alien to most people that haven't experienced that. So I think that helps. I mean, I know it's a bit of a simple answer, but I believe like just the fractionalization of really any kind of alternative assets, it has boomed across multiple. I mean, you've seen the application of NFTs to various assets and how that can be an advantage to it. And then you see, there's some great platforms making art, making tradables, collectibles, fractional to where, I saw a platform recently making, like really cool sneakers, fractionals where someone that understands that hey, this is an asset that I value and I think I understand it. But I don't know how to source it. I don't know in some cases how to manage it. I'm not the expert, or I don't have all this whatever the buy-in might be, the 10,000, the big ticket. So it's making something like that much more accessible. Robinhood as a stock trading platform, it's done some good and bad and whatever you might read. But one thing they did is they made that asset class much more accessible. And I think that's all a lot of presentation, language, and cost, fractionalizing shares and stuff. So I think that's a trend that's, to me, going to become the norm. I think we're just in the early innings of fractionalized ownership and restructuring of, debt vehicles and capital markets and everything in that same vein. It's a slow unwind considering all the systemic builds, but I think that's become a norm.
I think I love what you just brought up there too, because what's happening in Web3 and what's happening with NFTs. I think it goes to show that the younger generations are looking for places to put their money. They're looking for ways that they can go out and invest and buy low, sell high. And I think that's a great example. I think that's also kind of a really good segue and kind of into the next couple of things I wanted to ask you about. But along the lines of what's happening in the NFT Web3 space, the metaverse, future tech, I'm interested to hear a little bit about, what are some of the things that you guys are excited about at Nada? How do you think that might shape the future of fractional real estate investment? And, how do you think the way that as we're heading more towards decentralized applications, how do you think that might affect, potentially your product roadmap, but also the market that Nada operates in?
That's a good question. We as a company firmly believe in the, a decentralized network and the underlying, blockchain technology and applications in many areas. I mean, there's, the antiquated model of title holding for ownership is something, recording records in local counties.
Yeah.
That's something that I see happening. But for us, our primary focus is, we're kind of like that, how every now and then a generation comes back and becomes cool. Like maybe the 80s are cool now. Like we're kind of like that with real estate. It's like the old school alternative asset that's very standardized. We're really focused on, like, we fractionalize assets with real estate using securities and the compliance and stated models. But as the SEC starts looking more into NFTs as securities and regulates it where it's a little bit less of an open market, we intend to fully lean into that. I mean, we've looked into and talked to folks that are operating, a DAO structure, which is something that, in concept we believe in, and like the governance of, kind of a self-governed vehicle But we manage that a bit with an eye towards the regulators to ensure that we're operating within their swim lanes and navigating that appropriately until we see that mature. Something that we are interested in an immediate application would be the optionality that someone can invest in a city fund using their crypto assets, and it would just be it's like a clearinghouse exchange, right? We wouldn't be holding it, but we making it accessible. And we see that currently there may be some, considering the volatility there, that some early investors that got in would want to have an easy out, and to get into something like real estate might be an interest to them. I think one of the best things I've seen about it is the way that it creates communication and an eye towards really wealth building and community. It's pretty amazing in some of the projects that you can see, and Discord's a great platform for that. We have a Discord, and we're growing that channel, but just that's something that I hope can really manifest in other asset classes like real estate, and we've seen it to some degree. But it's just been, it still has this underground community vibe that I would identify with, considering my punk rock days.
Yeah.
So for us, it's kind of tipping our toes in it. We are very much exposed to it. One of our advisors and board members is co-founder of a company called Every Realm, which is a digital real estate and NFT fund that deals in that space. So we're plugged in there.
Cool. I think that's awesome. I love what you were just talking about too, just with, because real estate itself, and for anybody that's listening in the Web3 crypto space, I'm not trying to offend anybody, but like real estate it's an actual tangible asset class, right? Like I think one of the things that I always struggle with Web3 and crypto is that, and I think a lot of regulators talk about this too, right? Where it's like, what's propping up the valuation, right? And what's propping up the valuation, it's the demand from other people, right? And but the thing about the real estate market is that it's an actual tangible physical thing that so that I think that's why it's always been and always will be an asset class that you want to hold, right? Because it's something, there's something there. You pay X amount of dollars and you get a house, and if it's like and you get the land, or you get an apartment, right? So so I think that's when you're talking about being able to link fractional homeownership to, oh, hey, I just want to transfer some of my Bitcoin into this other tangible asset class. I think that'd be a huge win, not just for, fractional homeownership, but also for, crypto users and crypto investors to be able to quickly transfer assets from one place to another. I think that's one thing that maybe it's a turnoff for some people, because sometimes it's not as easy to buy crypto as they want it to be, right? And and everybody's always trying to get on these moonshots, and so that but in order to get on a moonshot, you got to get into like a mat, or you got to get into your wallet, and then you got to go over here and transfer it over here, and you got the gas fees. And anyways, I think once we actually get into those regulations and you're actually able to transfer out of a crypto asset class directly into a fractional real estate asset class, I think those are going to be some exciting times for sure.
Yeah, I totally agree.
Yeah, dude. Cool, man. Well, John, I appreciate you being on the show with us today. I think what you guys are doing at Nada is really cool. I love the idea of fractional homeownership. Makes everything similar, like you said, you get started with $250, like just sign up and get in the door, which, nowadays
own real estate.
And own real estate. Right. So I appreciate you taking the time to talk with us today. Before we go, Carlos, do you want to just quickly give us a summary of what we got coming up the rest of this week?
Sure, Eddie. My pleasure. Tomorrow, right here on Tech Backstage, we're going to be speaking with Per Nilsson, the Vice President of Engineering at Urban Footprint. And finally, on Friday, the conversation will be with Dennis Fox Bonilla at Balto Technologies. So that's what we have for this week. Join us right here on Tech Backstage tomorrow and Friday at 11 o'clock Pacific time. Remember, join us, be here, or be square. Thank you.
Cool. Thanks, Carlos. And John, thanks again for being here.
Thanks for having me, guys. I appreciate it.
Talk to you soon.